Let's look at accounting for treasury stock. This chart shows you dividends versus stock buybacks for the largest 1,000 listed companies in the U.S. This is from 1996 to 2016. As you can see, in the majority of years, stock purchases are greater than or equal to cash dividends. Now, companies buy back their own stock for various reasons. It could be to boost underpriced stock. It could be to distribute surplus cash without paying dividends. It could be to boost earnings per share. It could be to satisfy employee stock ownership plans. Sometimes students might confuse the purchase of treasury stock with investments in another company. An equity investment is the purchase of stock in another corporation, and we record that as an increase in assets. Treasury stock, on the other hand, is the purchase of a corporation's own stock, and we record it as a reduction in stockholders' equity. It's not an asset. A company cannot invest in itself. So let's look at accounting for the purchase of treasury stock. Canadian Falcon repurchases 100 shares of its own 1 cent par value common stock at $30 per share. They're going to debit treasury stock 100 shares at $30 apiece for $3,000. And they're going to credit cash for the $3,000. This is them purchasing their treasury stock. Now, the debited treasury stock reduces the stockholders' equity. Treasury stock is known as a contra equity account. This is an example of stockholders' equity before and after the purchase of treasury stock. So let's go ahead and look at before to begin with, okay? So they had preferred stock of $30,000, common stock of $10, and additional paid-in capital of $39,990. This gave them a total paid-in capital of $70,000, retained earnings of $30,000, for total stockholders' equity of $100,000. After they purchased treasury stock, this is what it looks like. Preferred stock is still sitting at $30,000. Common stock is still sitting at $10,000. Additional paid-in capital is still $39,990 for total paid-in capital of $70,000. Retained earnings is still $30,000, but then you've got treasury stock, which shows up as a negative number in the equity of $3,000, bringing your total stockholders' equity to $97,000. Now, let's say that the company reissues some of that treasury stock and they reissue it above cost. So Canadian Falcon resells 100 shares of treasury stock for $35. They originally purchased these for $30 per share. So they're going to debit cash for the amount of cash that they received. So 100 shares at $35 a piece. They're going to credit treasury stock for the value that treasury stock was purchased at. So the 100 shares at $30 a piece. The remainder will go to additional paid-in capital. This is that additional $5 per share. And this is how it looks when they resell treasury stock above cost. When we resell treasury shares at $35, we must reduce the treasury stock account at the same $30 per share. We will record that $500 difference, which is made up of 100 shares at $5 per share, as a credit to additional paid-in capital. Now we're going to look at the stockholders' equity section before and after the sale of the treasury stock. So this is what it looks like. Before, we still had $30,000 in preferred stock, $10,000 in common stock, additional paid-in capital of $39,990, bringing your total paid-in capital to $70,000. Retained earnings was $30,000, and the treasury stock was a negative impact on the equity of $3,000. The total stockholders' equity was $97,000. Now, after they sold that treasury stock, here's how things look. Preferred stock remains the same. Common stock remains the same. The additional paid-in capital went up that $500 extra that they sold the treasury stock for. The total paid-in capital is now $70,500. Retained earnings remains the same at $30,000. The treasury stock is now gone, so that's zero. So the total stockholders' equity is $100,500. Now, what if we reissue our treasury stock below the cost that we bought it at? Assume Canadian Falcon resells 100 shares of treasury stock for only $25 rather than that $35 in the last example. Recall that these shares were originally purchased at $30 per share. What's that going to look like? You're going to record your cash at the amount of cash you received. 100 shares at $25 a piece is a debit of $2,500. You're still going to credit treasury stock for the amount that you originally purchased it at. So 100 shares at $30 a piece, crediting treasury stock for $3,000. Additional paid in capital, on the other hand, that one's going to be debited for the $500 difference. This is what it looks like when you resell treasury stock below cost. When we resell the treasury shares for $25, we reduce the treasury stock account for the same $30 per share. We record that $500 difference, the 100 shares at $5 per share, as a decrease in additional paid-in capital. We include treasury stock in the stockholders' equity section of the balance sheet as a reduction in stockholders' equity. When we resell the treasury stock, we report the difference between its cost and the cash received as an increase or decrease in additional paid-in capital. Let's look at a concept check. Treasury stock, does it have a normal credit balance? Does it decrease stockholders' equity? Is it recorded as an investment, or does it increase stockholders' equity? If you chose B, you are correct. Treasury stock is known as a contra equity account, so it has a debit balance and it decreases stockholders' equity.